Target Corporation has been on a 2-year slide in share price, leading to a massive 50% spike in their dividend yield. Oddly enough, during this time, Target has put up some impressive sales growth and huge increases in their dividend. The drop in share price doesn't seem to make sense. In this video, we're going to explore how this household name generates revenue, analyze their dividend, and at the end of the video, we're going to see why investors have been panic selling this stock, so make sure you stick around for that. Target Corporation is a retail giant with a diverse business model that enables it to generate revenue through various channels. The company primarily makes money through its brick-and-mortar stores as well as its rapidly growing e-commerce platform. In physical stores, Target sells a wide range of products, including apparel, home goods, electronics, groceries, and more. These items are sourced from suppliers and manufacturers at wholesale prices and are sold to customers at a marked-up retail price, allowing Target to earn a profit on each sale. The company focuses on creating an inviting and unique shopping experience, which often leads to increased customer footfall and higher sales volumes. Additionally, Target operates a successful online store, allowing customers to shop from the convenience of their homes. Through its e-commerce platform, the company offers an extensive selection of products, competitive pricing, and efficient delivery options. Online sales contribute significantly to Target's revenue, especially as the demand for online shopping has surged in recent years. Furthermore, Target has its private label brands, which offer exclusive and differentiated products at competitive prices. These private labels generate higher margins for the company as they eliminate intermediary costs and create a sense of brand loyalty among customers. Moreover, Target enhances its revenue through strategic partnerships and collaborations. The company partners with various designers, celebrities, and brands to launch limited edition collections, generating buzz and attracting more customers to its stores. TGT's current dividend yield is 3.22%, which is significantly higher than their 5-year average yield of 2.43%. Target's 10-year dividend growth rate is 9.5%, and their 3-year dividend growth rate is 22.4%, indicating they're increasing their dividend growth. Target has raised their dividend every year for the past 56 years, landing them firmly in the category of dividend champion. Target is also in the S&P 500 and meets the market capitalization and trading volume requirements to be considered a Dividend King. Payout ratios on net income, operating cash flow, and free cash flow all remain below 66% over the past 5 years, though they did pay a dividend with negative free cash flow in 2022. TGT has had mixed financial growth over the past 5 years, with net income growing at 6%, operating income at 5%, operating cash flow declining at 3.5%, and free cash flow declining at 23.8%. The decline in free cash flow may concern you, as it did me when I first looked at it. On closer inspection, however, the negative free cash flow over the past year has mostly been due to their heavy investment in new stores and remodeling outdated locations. In 2022, Target opened 23 new stores and remodeled 140. In 2023, they plan on opening an additional 20 stores and remodeling close to 175. This investment will be worth it in the long run as new stores generate additional revenue and remodels typically result in an immediate 2 to 3% boost in sales. If we invest $1,000 in TGT today with an initial yield of 3.22%, 9.5% dividend growth, and 3% share price appreciation, our yield on cost after 20 years would be 47.39%, and our average annual return would be 8.3%. Over 20 years, almost $2,900 would have been paid in dividends, and we would earn over $500 on the 20th year. Given the solid fundamentals, why have investors been selling out of TGT so heavily over the past 2 years? As with most wacky things happening in the stock market, the answer lies in the virus that shall not be named. During the pandemic, Target was considered an essential retailer and remained open throughout the lockdowns. While the stock market as a whole dipped almost 30% in the early part of 2020, TGT barely skipped a beat, dropping only 19% and bouncing back almost 4 months sooner than the S&P 500. In the following months, Target rapidly deployed pickup and delivery options for shoppers, leading to massive growth in sales and income. Investors quickly seized the opportunity, fueling a 16-month bull run resulting in a 183% increase in share price. As the world opened up again and lockdown restrictions loosened, the buying craze around TGT cooled significantly. Growth in sales continued, but at a much slower pace than what was seen during the pandemic. So investors holding TGT at these historic prices began to panic and sell. Since August of 2021, Target's share price has declined precipitously, but now we're nearing pre-pandemic levels again. Since early 2020, Target has raised their dividend by 72% from 66 cents per share to $1.10 per share. This increase in dividend coupled with the decline in share price has led to a massive spike in Target's dividend yield and opened up the door for long-term investors to get in at bargain prices. I believe once the share price drops below $120 or maybe $110, the market will start to pick up TGT again at a more sustainable rate. As for me, I'm going to be buying TGT through that whole process. This Dividend King has seen some highly volatile movement over the past couple years, but it looks like things are starting to cool down for now. The fundamentals of Target are sound, and I think now is a good time to capitalize on market panic. Since the dividend has increased by over 40 cents per share since 2020, the yield is approaching all-time highs. Altogether, this makes for a solid opportunity for long-term investors. Target is definitely one of the best deals on the market today, but there are many other solid picks you can choose from. One stock in particular is Bank of Ozark, or OZK. This stock has seen massive dividend growth over the past few years, and it's hard to find a banking stock better suited for dividend investors. Click on the video card here or the link in the description to watch our analysis of this stock. Thanks so much for watching. Till next time, stay safe and take it easy.